Well, let's take another look at our ag commodity trade, and we'll begin with a look at our grain markets here. We'll start with the corn, and our quotes provided by Bar Chart. Of course, everybody's talking about all the violence ramping up going on in Afghanistan, increasing tensions everywhere. And the question is it going to have spillover impacts on the equity markets, the financial markets, the commodity markets, and everything related? Well, so far on the corn, we're holding the status quo. We have December corn 0.75 cents higher. We're at 552.5. So we're still within a couple ticks of our high of the day, but it's just not doing much as we get closer and closer to the core of fall harvest here on the corn. Not very far away. It's already started in some areas. November soybeans, well, they're down 6.5 cents right now at 13.26 1/4. In January, down 6.5 cents. Now, we did have some overnight export sales this morning, but it doesn't seem to help the soybeans whatsoever. In fact, we had 2 sales of soybeans this morning. A couple of boatloads were sold to China, and then you had roughly the equivalent of a couple of boatloads sold to somebody else, 132,150 tons to unknown. Had a little corn sold to Colombia, too. 100,000 tons went there. So we'll add that onto the roster for the next weekly report that comes out. Now, let's update our wheat. And the wheat took the leadership role this morning by far. We had Chicago December now 9.25 higher at 734.75. Kansas City, we have December now trading at 724. That's up 9 cents on the day from our close yesterday. And Minneapolis December wheat 3.25 higher at 911.25. Let's bring in Ted Seifried of Zaner Ag Hedge in Chicago and sort all this out. All kinds of stuff going on. We have the Fed meeting going on this week. We have all kinds of stuff going on in Asia and the Middle East. Just all kinds of turmoil. You have harvest ramping up. You have rain going through the Midwest, and it's hard to figure out what to do. You have September options expiring tomorrow, right?
A little overwhelming, Marlon. Sure is. But yeah, to your point, we are sort of on edge here, waiting to see what happens with, we talk about risk on, risk off days. Well, this is certainly not a risk on day with all the news that's hitting at the moment. But to this point, it's not a big risk off day either. I mean, you've got the S&P down 17, 18 points. You've got the Dow down 70, 80. You do have the dollar a little bit higher. You have crude oil a little bit lower, but nothing dramatic yet. So we're just kind of waiting here to see what happens. Now, export sales. Yes, we had, and I'm going to say that unknown sales, probably China because of the amount, right? But an explicit sale of 133,000 to China, 132.125 to unknown. We had really good export sales for soybeans last week at 1.75 million metric tons. But again, these are numbers that we want to see bigger numbers. Before we can start really price rationing demand, we have to see that demand coming in. And I've been contending that we should still go down and make those harvest lows and give that demand a chance to show itself. And then once that happens, then we can start getting excited about the balance sheet and the tightness that we have for next year. We still have weather going on. That is certainly something that we'll be watching very closely. And after the 3-day bounce that we've had in soybeans here, running into some very key resistance, our cluster of moving averages. Not surprised that we're pulling back a little bit today. However, it's certainly not falling apart, and corn does want to lean higher. So like you said, there's a lot of things going on right now. Market seems very indecisive about where it wants to go. But again, my contention is I would think it would be healthy for the market to have a bit of a downdraft here, go and find those bigger demand numbers specifically for soybeans, and then we can start to rally. For corn, I don't feel quite the same way because of the issues with the second season safrinha corn crop. We're going to find that demand pretty quickly. I think that demand's there either way. Yes, end users will want to wait to try to buy for better prices because they know that seasonally they have a chance to do that right now. But I don't think they'll wait that long. So again, I'm talking for soybeans. I think we should see a break in the market. I think it'd be healthy. This would be the right time to do it. So we'll see what happens.
All right. Well, Ted, we'll come back and take a look at cattle and hogs on the other side of these messages. Don't go anywhere. Well, we're back with you, and we're talking with Ted Seifried of Zaner Ag Hedge in Chicago. Let's look at our live cattle trade here, Ted. See what the futures are doing today. The grain markets are just kind of all mixed up all over the place. Live cattle definitely lower, though. We have October live cattle down 67. Check that now, down 70 cents. We're at 129.60 per hundredweight. That would be basically in the neighborhood of about 80 cents off of our earlier high of the day. We have December down 70 cents right now. Moving on to our feeders and our quotes provided by bar chart here, you have September feeders now $1.02 lower at 164.12. That's off of our earlier high today by about $1.80 roughly, and that's not necessarily technically a real good sign. October down $1.45. Meanwhile, on the lean hog trade, we now have October just 2 cents higher at 88.77. Things have softened up quite a bit here. We're about 80 cents off our earlier high of the day. December now down a dime at 81.85. So what do you see happening here on the livestock trade?
Yeah, Marlon, just as we got done saying that, it's not so bad as a risk-off day and the stock market's kind of holding up. Well, then the S&P dropped another 7 points while we were in commercial break. So I think that's starting to creep into the market a little bit more. I think that's part of the reason why we backed off the highs. When you look at cattle, we had that breakout to the upside that, after a very long period of consolidation, we broke out to the upside on Monday. We couldn't follow through on Tuesday. We closed poorly. We were down yesterday. And now we're just kind of floundering and coming back down with that sort of risk-off trade that's coming into the market. So I don't know. Fundamentally, I see reason for cattle to want to go higher. Box beef prices are really still very strong, although they backed off a little bit yesterday. Packers margins are really fantastic. You can justify higher cash. We should, in my opinion, see higher cash trade, which should help the board. But, again, if we're going to get into more of a risk-off trade, well, then we'll start worrying about demand a little bit. We'll worry about the stock market. We'll worry about disposable income and so on and so forth. So once again, there's so many things going on right now. Markets are uneasy about making any decisive moves at the moment as we wait to see how things develop on so many different fronts. And as far as hogs are concerned, we've been very sideways here the last few days. I still think that October hog contract has good reason to get into the mid to upper 90s, possibly in the low 100s. Maybe not to the 120s that the August contract got to at times, but I see upside potential there. The big question mark is what happens macroeconomically, and like you said, Fed, right. Afghanistan, COVID, Delta, so many things going on. It's just very difficult to get a gauge of what's going on macroeconomically.
A lot of balls in the air right now, as they say. All right. Well, thank you very much, Ted. Good to talk with you again. Ted Seifried of Zaner Ag Hedge with us. A lot going on today, Janet. We'll stay on top of it.